namely something that only 68% of people have, is a great financial benefit, and the people that do have them don't even know how to use them. If you said a TFSA, you guessed correctly. Why has a TFSA been such a financial Rubik's Cube for so many people? Well, in this video, we're going to break down the rules of the TFSA and how you should and should not use it. And make sure you stick around to the end because I got 4 tips to help your TFSA grow. Let's get to it. Starting from the top, TFSA is an acronym that stands for Tax-Free Savings Account. Just as the name suggests, it's an account designed for you to park money in. Well, hold up. Let's be honest. When we think of a savings account, you think of one that's high yield. You know, one with an interest rate attached to it. You know, designed for growth. So, a tax-free savings account should have that same property, right? No. The savings portion of the tax-free savings account refers to the fact that you're able to park money into it and that you have specific contribution limits per year. But there is no rate of return or interest rate that is built into the TFSA that your funds will be exposed to. So this begs the question.
Why would you use it to save with if you're not going to get a single % of interest?
I don't know, I guess we'll just ask the hundreds of thousands of people that are doing it wrong. I know another question you're asking as well. If the tax-free savings account isn't just for savings, then at least everything I put into it lowers my taxable income, right? Wrong again. The tax-free portion does not mean that your tax bracket is lowered when you contribute to your TFSA. What it actually means is that any gain or growth on the money within your TFSA is tax-free.
But didn't you just say that TFSAs don't come with an interest rate attached? So how do we take advantage of the tax-free gains?
There's a couple ways to do this. If you have a TFSA with your financial institution, you can put mutual funds and GICs within it. Both of these investment instruments have rates of return. If you were to make contributions to the mutual fund, for example, the money would grow over time instead of stagnating, just being saved. Now here's where the tax-free part comes into play. Any investment income that is made as a gain on the investments in your TFSA are tax-free. And if you wish to withdraw all or a portion of the funds within your TFSA, you can do that tax-free as well. The scenario I just described involves opening a regular TFSA. There is, however, another TFSA option for the more savvy investor. Opening what we call a self-directed TFSA gives you a little more flexibility if you know how to allocate your investments. With a self-directed TFSA, you can hold stocks, bonds, mutual funds, ETFs, and cash. With the ability to diversify your TFSA like this, there's a lot more potential for growth and an ability to take advantage of those tax benefits. Now, let's break down the 3 basic rules that govern the TFSA. First rule is, each year you have a contribution limit that you are allowed. For the past 3 years, that limit has been $6,000. The second rule is, you can withdraw from your TFSA freely without penalty. However, any withdrawal you make doesn't add back contribution rule. Finally, the TFSA does not reduce your taxable income like the RSP does. So after all that, how do you make a TFSA grow? Let me give you 4 tips to help you maximize that TFSA growth. My first recommendation is that you open interest-bearing investment instruments within your TFSA. So many people have regular TFSAs that they may or may not make contributions to. But you can have your financial institution open a mutual fund or GIC within a TFSA, and then you can get a return on whatever you contribute to it. Number 2 is have multiple TFSAs. Keep contributing to a regular TFSA, but open a self-directed one as well. This way you can actually invest in company stock, ETFs, bonds, index funds, and mutual funds. And by doing that, you increase your chances for long-term gain. Number 3 is don't withdraw. I know this sounds simple and obvious, but if you consider your TFSA as an emergency savings, you're going to be tempted to use it as such. Even occasional withdrawals can counteract the compounding effect of the rate of return that you're receiving. And number 4, contribute consistently. Try to maximize your contributions each year. Can you imagine if one of your investments doubles? You won't pay a single cent of taxes on that gain. But if you don't contribute, you won't have that opportunity. So contribute often. So if you don't already have a TFSA, please go ahead and get one. They are free to open. If you like this content, please give us a thumbs up and subscribe. And please don't hesitate to drop a comment as well. Thank you so much for watching, and we'll see you next time.